Recipes for technical trading success in Cook's Kitchen.
Welcome to the Not Good Enough earnings season. I'm Kevin Cook. Welcome back to Cook's Kitchen. I've been out for a little while. It's time to dive into this market and see if this earnings season can give us better reasons to be bullish, and we can talk enthusiastically, positively about new highs for the stock market. And why is that my bias? Because the economy is still accelerating, earnings are still accelerating, the bull market's not over. Yeah, interest rates are creeping up a little bit, but the bull market's not over. So new highs are coming. Now, whether that takes another 5 to 6 months after the midterm elections and into a strong fourth quarter, or we get it, say in June, July, we don't know yet. So let's turn to the charts and earnings season. The first chart I want to show you is the Semiconductor Index. Now, I've drawn a channel, and I'll explain why it looks like it's drawn by my kid with a crayon in a moment. But we had a really nice channel going after the February lows. The semiconductors made new highs, come down, make a higher low. So the first ellipse up there is new highs for the SOX index in early March, come down into late March, early April, and what do we make? We make a higher low versus the February correction. Very positive. We have since broken through that. We've damaged the chart. We've lost the structure. Okay, so why do I draw those types of trend lines? Because I hate trend lines. Trend lines are mathematically absurd. Let me show you what I'm talking about. Back in June of 2016, I made a little video called Trend Lines Are Mathematically Absurd. You can find it just by Googling Zacks Trend Lines, and it'll be the first result, I hope. Take you to Zacks.com, where there's an article and a lengthy video. To cut to the chase, I'll tell you, I give 3 reasons why trend lines are mathematically absurd. My third reason is that markets are not linear, okay? And I explain all this stuff about complexity, but the bottom line is that markets are the most complex, dynamic, multidimensional systems on the planet, more complex than biology. They're social systems, they're social beasts, and so if anything, they follow the laws of Benoit Mandelbrot or Nassim Taleb, that randomness is wild, and just about anything can happen. So your standard bell curve volatility does not contain what a market is capable of. So find that video and article, just search Zacks Trend Lines and you'll find it. And leave your comments or shoot me an email or something, because this is really important stuff. You've got the whole technical analysis world still drawing straight lines on charts. And as you can see here on my list, I asked the question, why would a complex system, the most complex system, obey an arbitrary straight line through time? Okay, that's the important question there. Okay, back to the charts. Now let's look at a weaker sector out of the February correction, industrials. Again, I draw my channels of what do we have in the industrials? We ended up with lower highs. You see that while semiconductors were soaring to new highs, industrials were not. They made a lower high in early March, and then just kind of bumping along on their 200-day moving average here in early April, now back down to the 200-day moving average. And that's all about, what earnings did we have early this week? We had Caterpillar with great earnings. United Technologies with a pretty strong report. 3M bombed, and those 3 combined took the market down. Why did Cat go down? Well, the analysts were so excited about that earnings report that on the conference call, management decided to temper the enthusiasm and talk about how, hey, these margins are great, but they're probably peaked, and this is about as good as it gets. So then they took those stocks down, and back to the chart here. Industrials don't look so great. On the bottom, I included the MACD I circled the MACD down there with a green ellipse just to show you that's an ugly looking MACD. It's a market that is cringing under its own weight, so to speak. And if this thing all of a sudden stands up and launches off the 200-day moving average, I would be very surprised. So And how much of this is about the tariffs? I would imagine about 50% of it is that uncertainty being baked into the industrials. And nobody knows how that's going to unfold, right? So that's a thing where institutional investors are sort of gun shy because of the uncertainty, and we don't know what corporations are going to do. Are corporations going to start pulling back a little bit on CapEx, or hedging their bets in other ways in terms of expansion, because they don't know what the next 3 to 12 months looks like for global trade? It's a possibility. This week we get the most S&P reports. About 190 S&P companies report this week of April 23rd. And, we want to listen to these conference calls. What are any management teams saying things about the tariffs? Are they being asked questions about the tariffs and the potential impact? All right, back to the charts. Next up, the Nasdaq 100. Looks a lot like the SOX, right? Out of the February correction lows, we get this surge to new highs in early March, come down, make a higher low versus the correction lows, but now we're right back there. And I took these charts were made on Wednesday morning, April 25th, and you're looking at sort of a bounce. The Nasdaq comes down. Nasdaq 100 comes down just near 6,400, bounces back up above 6,500. I'm not so sure if it's going to hold it. I actually want to be a buyer though when this comes down, because if you look at the chart of the triple Qs, look at the 154 level. If you have a chance this week, look at the triple Qs and see that the last swing low that we'd be talking about early April lines up with the 200-day moving average around 154. And it doesn't need to line up exactly. I'm just saying I think that's a high probability place to look for a bounce or even a puncture and then a recovery. And so I plan to be a buyer of more NASDAQ growth stocks when the NASDAQ pulls back further. On the NASDAQ 100, that would be about, say, 63.25 to 63.45. All right? Okay, and look at the MACD there, back on the NASDAQ 100 chart. MACD looks like it's got a chance to turn. If we can make a flush and come back up, that works for me. All right, now let's talk about earnings. So, why should we be optimistic about this market? This is from last week, April 18th, when our Director of Research, Shiraz Mian, last updated it. This is quarterly earnings growth year over year, so comparing, this quarter to the same quarter a year ago. And so you see Q1 that, we're getting reports for now, last week was estimated at 17.8% earnings growth. Based on the reports we've already gotten, that number is already above 18.5. So we're already, the beats are coming in. The beats are hot this earnings season. And so this is going to be a really strong earnings season. And who knows? It may create a bottom for us here. I mean, really, that's what we need. I called this the not good enough earnings season because it really has to show us. It really needs to give us a reason to be bullish. And if you think about it, do the math. You could do the math as simply as this. What's the valuation of the S&P? If earnings estimates are at $155, looking out the next, annual estimates for the next year, at S&P 2800, that's 18 times, okay? So that's a little bit rich on a forward basis. And so everybody's afraid to be paying that, unless we see that those estimates are going to be moving up from 155, say up to 160, and not down back to 150. Okay, so back to the S&P quarterly earnings growth. Again, this is year over year, so you're looking at this fantastic growth. Q1 is going to be great. Q2 sequentially could end up being lower than Q1. We'll see, depending on guidance. And Q3 looks really strong right now. Again, that's just estimates. That who knows? That could come down. This is a reason for the bull market to continue with these. You're talking record corporate profits and sustainable growth. Okay, now let's look at tech. All right. So tech has been the strongest sector. I've been very bullish on tech. You know, the earnings growth has been the strongest. It's also been a leader. So whether it's semiconductors, I mean, everything in tech is working. Hardware, software, semis, no doubt, and you know, diversified with you know, players like NVIDIA and other things. Let's look at the possibility of an earnings peak for technology. So you've got all of 2017 in the dark green bars. Those were the year-over-year quarterly earnings advances for the technology sector. Now we come into Q1. What happens? Because of those terrific green bars in 2017, the comps or the comparables get much tougher. So even though we're growing, you know, expected 21%, sequentially it's down. Then Q2, 19%. Q3, of course they're sequentially down because it's so hard to beat those comparables. We're clobbering great numbers from a year ago. So that makes tech investors wonder, hey, is this as good as it gets? And we should be selling into any rallies. That appears to be what's going on now, combined with tariff concerns, combined with interest rates moving higher. Even though there's no evidence that the economy is going to slow down or that we've reached cyclical peaks in the expansion, that's the way investors are acting. So I think we're going to get a better opportunity to buy this market, and you do want to buy it. Now, I have said that the S&P doesn't go to 2,400 just because I see strong support there and good valuation. It still could. You know, if we break you know, these recent lows, the way some of the charts look, you know, then we're talking about S&P 2,400. And so I think you want to have some cash just in case that happens. In the meantime, you're not going to time it perfectly. No one ever does. So you scale in. You look for big dips, buy those, and then look for the really big one. All right, I think I covered everything. Check back with this week. Shiraz will update these earnings charts, and you'll see how great Q1 is looking right now, and if those Q2 or Q3 estimates change. All right, thanks for joining me in the kitchen.